Hello, everyone. I hope you're doing well. If you don't already know who it is, it's the one and only, the true Alex J. And this is obviously the Entrepreneur News podcast. Today, I'm absolutely honored to have Burton Malkiel on with us. He's a professor of economics. He's an author of 11 books, almost 200 research papers released. He's a former board member of Vanguard, currently a board member and chief investment officer at Wealthfront, which is an automated investment advisory, and he's also an investment committee member at rebalance.com. How are you?
I'm very well, thank you.
Awesome. I'm glad to hear it. Now, obviously, you wrote a book in 1973, which is a classic all around the world, called A Random Walk Down Wall Street. What is it that inspired you or motivated you to write this book in the first place?
Well, I started my career working on Wall Street as an investment banker, and I became very skeptical about how well investment advisors and brokers were doing, and whether their advice to individual investors was good advice or not, and whether or not individuals were in fact investing wisely. So being skeptical of much of this, and particularly about much of the very expensive so-called active management of an equity portfolio, by which I mean trying to switch between security to security, picking the best security, avoiding the worst securities. I became just extremely skeptical that anyone was able to do this well, and that, in fact, markets were quite efficient in the sense that they reflected news quite quickly, indeed, right away. If a drug company announced that it had an effective cure for a particular strain of cancer, that would be reflected right away in the price of the security. And hence, the investment advice would be, rather than trying to buy individual securities, rather than trying to find securities that might be, quote, undervalued and avoid those that were, quote, overvalued, that maybe the best thing to do would be simply to buy and hold an index comprising all the securities that are available for investment. And what I said in the first edition of the book was, the problem is that when you tell people they ought to simply buy and hold an index, people answer, but you can't do that. There were no index funds. And so I said in the first edition of the book, well, there ought to be one. Well, 3 years later, the Vanguard Group actually produced the first index fund. In fact, it was called the first index fund. And it was very slow to take over, very slow to gain traction, in that so-called active managers said, who wants to be mediocre? Who wants to be average? We can be above average. But in fact, the evidence accumulated, and this is one of the reasons why I do more and more editions of the book. In fact, the 12th edition of the book has a publication date of January 1, 2019, well, what's the evidence? What's happened? And in fact, the evidence is that index funds have tended in every year to outperform actively managed funds, about 2/3 of them. And the ones that do outperform in one year aren't the same that outperform in the next year. And therefore, when you look over a period of 10 or 15 years, what you find is that over 90% of active managers are outperformed by a simple low-cost index fund. And, it's not that nobody outperforms. There are a precious few. But in fact, if you try to do that, you're much more likely to be in the 90% of the distribution rather than the top 10%. And so my advice, which has been consistent in every edition of the book, is that at least the core of every portfolio should consist of low-cost index funds.
Yeah, absolutely. And it's funny that you say that, because obviously before we were doing this, I'm not a Wall Street titan or anything like that. So I was having to research a lot of the words that you were saying, especially when you're talking about index funds, because obviously I know that you've spoken about those quite a lot in the book. So for me, what I found interesting was the fact that you said that there are some that will outperform, but the problem is that they're just not consistent. And if they were consistent, so you said that there's a rare few. Do you know the percentage that is?
Well, as I say, when you look over 15 years, it's about 10%. But the problem is there's no way to know in advance who they will be, because if you were in the top 10% in, let's say, 2017, that didn't mean you were going to be in the top 10% in 2018. So it's this inconsistency that is the problem. And that's why, the advice is to index. Let me give you an analogy. If let's say that you could show that out of 20 alcoholics, 2 of them could be able to resume as social drinkers. The problem is you don't know who the 2 are, and in the meantime, if you tried to predict in advance, you might ruin all the rest. So this is the problem. It's like looking for a needle in a haystack, and you're far safer, if you wish, buying the haystack, that is, buying the simple index fund.
Absolutely. And so I noticed that there was a quote from your book, which I thought was hilarious. It says, "A blindfolded monkey throwing darts at a newspaper's financial pages could select a better portfolio than one carefully selected by experts," which I thought was rather amusing. It paints a beautiful image in my mind as well.
And so it's in fact true.
Why do you think that is? Why do you think it's so difficult to consistently perform?
I think it is difficult for 2 reasons. One, because there is so much randomness and so much chance in life that you never know exactly what's going to happen. Let me go back to the analogy that I used about the pharmaceutical company. And certainly all of them are looking for the next cure for cancer. And sometimes you have something that really looks great. And in some of the early trials, it seems to have produced a cure. And then what you do in the pharmaceutical industry is you have a so-called phase 3 trial where you have a very large number of people who are given the drug, and uh, so many 70, 80, 90% of phase 3 trials have in fact failed to work and failed to demonstrate that products that we thought were really effective are effective, or alternatively, they might be effective, but the side effects are so negative that, yep, you might kill the cancer, but you also kill the patient as well. So I think the
Right.
first thing is this idea of randomness in life. And second, the idea that there are many, many smart people in the financial community. And if they think there's a piece of evidence that has not been reflected in the market, what they do is they immediately bid up the price of the stock so that what the efficient market hypothesis says is that really markets are very efficient in reflecting the news. There aren't these clear pockets where there are opportunities that people have not already exploited. And if that's in fact the case, that it's not that markets are always correct. Lord knows most, in fact, they're wrong. But if nobody knows for sure whether the price of the stock is too high or too low, you're just much better off being diversified and buying everything, and that should be the core of one's portfolio.
Okay, and so going with that exact theme, obviously no one can really know if it's priced too high or too low. One theme that I've seen recurring, and I think this has probably gone on for longer than I've existed, but every year, or at this point, it's probably every month, someone comes out with a book and they're on TV and they're saying the market crash is going to be tomorrow, and it, like everyone is predicting a crash, and it's always their date, and everyone has a date that they think is going to crash. I'm kind of want to get your opinion. Do you think there's going to be a crash? Is it inevitable? Do you think it's possible to predict it, or what's your opinion on the crash?
Well, you're absolutely right. There have been crashes in the past. There are always 10 or 15 people who say the crash will occur on a particular date. And, it's always the case that there is somebody who has done one of these predictions that there will be a crash, and there was a crash because we've had crashes. The problem is what you can't find are the people who have been able to be consistent in that they will tell you when all the crashes occur. Markets are very volatile. They are particularly volatile now. We will have crashes in the future. I am sure of that. But there is nobody, and I mean nobody, who's going to be able to tell you for sure if and when it's going to occur.
So, would you say to someone, let's say that you're just looking at investing in the stock market, it's your first time walking in, you've just saved up some cash. Would you say that now would be a good time to get in, or would you say just kind of wait until a crash hits and then invest? Or what would your advice be to someone that's brand new, they've just literally got some liquidity? What would you say to them?
I think that nobody, and I mean nobody, can tell you when is the right time to invest. And what my advice has always been is to do so-called dollar cost averaging. And what that means is if one puts a little money into the market consistently in good times and bad, excuse me, that person will have a very good result. Because what happens is when you periodically put a certain dollar amount, let's say we're talking about US dollars, a certain dollar amount in the market every month, every quarter, every year, sometimes it will turn out to be a very good time. Sometimes it'll turn out to be a less good time. But the beauty of this so-called dollar cost averaging is that you buy more shares when the prices are low, and therefore the average cost of the shares in your portfolio will turn out to be lower than the average of the prices. And again, that's because you're buying more when prices are low and buying fewer shares when prices are high. And what is clear is that is a much lower risk way of putting money into the market, and it is a way of investing that is the surest way for someone saving for retirement to have at the time of retirement a quite reasonable nest egg.
And at what age would you say for someone to start? So let's say that they're going to follow your advice. They want to invest every month, until their retirement. At what age should they begin? Should they start at 18?
The earlier,
when they've just got their first
the
job?
better. The earlier, the better, because Albert Einstein is quoted as saying, "The strongest force in the world is the force of compound interest." And the earlier you start, the more years you have for compounding the returns from the investment. You know, one of the analogies that I use in the book is it is often said that Europeans really duped the Native Americans in the United States by buying Manhattan Island for the equivalent of $16. Well, it turns out that if in fact that $16 had been invested at 5, 6, or 7% and had compounded since the 1600s, that in fact you could now buy back all of New York and the improvements that have been made and all of the buildings that have been built because of that compounding. So my advice is very clear, that you want to start as early as possible, and you want to make sure, because look, this is the mistake that people make. Things are getting very uncertain. There've just been a crash. What people sometimes do is they say, "Oh my God, I can't stand this anymore. I'm going to stop investing. I'll even take out some of the investments that I have made." And that's the cardinal error. What you need to do this is consistently, no matter how frightened you are. The best times to invest are when everyone is terribly fearful of putting money into the market.
That's very, very powerful what you just said, and it resonates really strongly with me. I was taught by my mentor, because I buy property. That's my thing. And I reached out to him and I said, "Look, I'm really nervous about if there's a market crash. Do I wait? Do I buy properties after the crash?" And this is like 4 years ago, and I was saying, like, because I'd seen it on TV, everyone was talking about crashes, and I'm saying, "Look, should I just wait until after the crash?" And he said, "Look, Alex, I don't know when the crash is going to be. just buy the damn property. And he's like, just keep buying it. And when the crash comes, buy more.
You
He's
bet.
like, don't freak out. And it's a really strange thought process that I had to kind of go through, where I'd been battling with that because I'd always been fearful, and I kept thinking, if a crash is going to come, I'm going to lose money on the properties and everything else. But if you look at it over the long term, like on a much longer play, it all balances out either way.
No,
So
and
as long
it's
as
the
you
right
keep
thing to
going.
do. And unfortunately, uh, generally people do just the opposite. What we know about mutual fund investors is they tend to put money in when everyone is optimistic. They tend to take the money out just when the market is crashing and everyone is pessimistic. So they do exactly the wrong thing, and therefore they lose the advantage of the long run rate of return that you get from the growth of the world economy.
So okay, so let's go with that. Now, I kind of want to go into a darker territory. Bitcoin, I'm guessing you've heard of it. That was, for me, the craziest thing to have ever watched. We watched this. I mean, I actually, firstly, I want to get your opinion on Bitcoin before I start ripping it to shreds.
Okay. One of the things that I warn people about, since people are prone to put more money in when something is going up a lot, and when something is very popular, I have some chapters in the book about huge historical bubbles. The classic one started in the 1600s in Holland, where people bid up the price of tulip bulbs so that at one point, one tulip bulb sold for the cost of the equivalent cost of a nobleman's castle. I mean, it was absolute madness. There was then the crash where tulip bulbs were basically worthless. There was a bubble in the 1800s called the South Sea bubble in England and on the continent. And one of the things that I have put in the 12th edition of the book that's just about to come out, January 1, 19 is the publication date, is a long section which I call the Bitcoin bubble. And so the answer to your question is I think it was absolute madness. You got something that there was an enormous amount of publicity about, that this was the way that you became a millionaire or a billionaire. And a Bitcoin sold as high as $20,000 US dollars for one Bitcoin. The last time I looked, it was selling below $4,000. This is exactly the kind of thing you want to avoid as an investor. But these kinds of bubbles occur periodically. You never know how high they're going to go, but invariably at some point they will all crash, as the Bitcoin did. Maybe it'll start going up again for a while, but my advice to investors is avoid it like the plague.
It was certainly was a strange thing to watch. We was, again, I'm not really a forex person, but obviously I was, it was very difficult not to see what was going on with Bitcoin, and I was seeing it everywhere I went. And my wife looked over to me and she's like, Alex, I think you need to buy a few of those Bitcoins. And I said, you know what? I don't think I do. Because I said, the thing that's worrying me is the fact that you know what it is. And that you're telling me I'm going to make millions off of this thing. I said, that's a scary thing because you have no idea about finance. Why are you talking to me about finance? So I
Well,
was like, this can't be a
look,
good sign.
this is exactly the problem of the publicity that this got. It even entered into some of the episodes of cartoons that children watch, such as the Simpsons is a cartoon that a lot of children watch, and so much so that the story is that one little 10-year-old asked his parents, "Could I have my allowance in Bitcoin?"
Well, I bet he's disappointed. Disappointed
If
now.
he got his allowance in Bitcoin, he would be disappointed today. Exactly.
Well, we had clients coming to us. It wasn't a lot, but there was a few clients that came to us and they said, and this is when it was rising rapidly, and they said to us, "Can we pay in Bitcoin?" I said, "No, there's absolutely no way I'm going to take that thing because I don't know how far it's going to drop, and I don't know how to withdraw this stuff." I was just like, just pay me cash, right? I know how cash works. I know how it operates. I know what to do with it. Don't pay me in this Bitcoin thing. But yeah, it was definitely a strange thing to witness, and I mean, there's still some. I mean, I personally think it's crazy, but I still see news out there where people are making the most insane predictions. December it's gonna hit 100,000. I'm like, it's not.
Right, right,
It's not. I
right.
think I think we should calm down and just accept reality at this point.
Yeah.
No
Well,
matter how
look,
much.
let me say one thing. Let me say one thing positive about Bitcoin, and it's
Mhm.
both positive, and it is also the reason why it's not ever going to be the currency of choice. The positive thing is that it's quite anonymous, and the if you pay in Bitcoin, this is something that is hard to trace, and therefore Bitcoin tends to be favored by people who are making illegal or illicit transactions. In
Mhm.
fact, some people have called Bitcoin's use an index of money laundering. So,
Mhm.
in some sense, that's an advantage if you want to do something illegal, but it's also one of the reasons why, if Bitcoin really became the currency of choice for most people, governments aren't going to allow it. Governments want to be able to trace these illegal transactions. So, again, I think this is the kind of thing you want to avoid like the plague.
Right, of course. And so here's another strange thing that kind of happened. So just before, and this is more in the social media world, which is kind of a part of the world that I joined for a period of time where there's a lot of business owners, and it's very interesting to watch entrepreneurs on social media because you can kind of, as a collective, you can see what everyone's into and what everyone's doing, and I enjoy watching to see what the collective is doing even
Mm-hmm.
though personally I'm not involved with it. And one thing that I noticed was that there was a phase where everyone became forex experts overnight. That was a phase that came in, and then it slowly became everyone was a Bitcoin expert. And then because Bitcoin's dying out again, everyone's gone back to being forex experts again. And the thing that I kind of want to get your opinion on because I find it insane that this is still happening and people are still being drawn in by this. There's these multi-level marketing companies that are claiming, um, they said if you join with us, we can either trade your account for you or we can teach you to trade, which sounds fine and dandy, but you're talking about 18-year-olds or 19-year-olds that are going to 40 plus year old individuals and saying to them, give me your life savings and let me trade it for you because I watched a few videos on this website and now I know what I'm doing. And that to me was like, holy, like this is a very, very worrying thing for me. And this is like a dark time for social media. But it seems that, I mean, it's been going on for years and they're still getting away with it. But I kind of want your opinion on, I mean, have you ever seen that before? Have you ever witnessed that before?
Oh, absolutely. In fact, we have witnessed it many times in history. This is why I have wanted in my writings to make sure that people understand the bubbles that have occurred in history, and that people have understood that all of us are fascinated by the idea that there is some get-rich-quick scheme that is going to transform our lives. I mean, why do people buy lottery tickets where the chance of winning is infinitesimal, and the payoffs are much smaller than the true odds are? Why do people love horse racing? Why do people particularly bet long shots? Why do people flock to Macau to gamble, where the winners are the casinos, not the players? This has been, there's maybe something in our DNA that makes us susceptible to this. And my sense is that this is going to be the case in years to come as well. So what we want to do is just be warned that there's a natural instinct to be prone to get rich quick schemes, but they typically end in disaster for the individual.
Well, it's funny that you mentioned Macau because I went to Macau. I think it was last year, or maybe it was the year before that. Um, and it was a very unique place. Obviously, the Chinese culture, they love to gamble, and I went into a casino, and I haven't been to a casino in many many years. And when I was 18, I mean, I don't know about in America. I think it's older than that, but in the UK, the gambling age is 18. So I went into I worked downstairs, and 3 floors above me was the biggest casino in Europe. So that's a fantastic thing to have upstairs. So what I did was I went in there with £5, and I went to a roulette table, and I was just doing red or black. And I, by chance, managed to go from £5 to £10. And I was like, brilliant, I've just made £5. And I withdrew, and I went downstairs and I bought free breakfast. For some reason, and I don't know how this has happened. I mean, I'd love to say coincidence, but it's just the amount of times it happened. I would go in every morning and I would always put £5 down, and I could always get it to exactly £10 and withdraw. And so I would do that every morning. For me, it was just a free breakfast. And I remember the casino manager coming over to me and he said, why don't you try and get to 100? And I said, because that's never going to happen. I know that there is no way in a million years that I'm going to be able to make that get to 100. I don't know why I'm able to get it to 10, but I'm happy with that and I'm fine with that. I'm not stupid enough to keep trying. But when we went to Macau, I was telling my wife this story. I said, I managed to go like a year getting free breakfasts. And I said, look, I'll show you. And I'd been drinking, but I was super confident. I put the money on the table. I start with £5. I got it to 10, and then I don't know why, but I decided that I was going to try and go for 100. It was just a conscious decision. I'm going to get to 100, and I managed to get to $97, and then I started losing, and it was the most frustrating experience because I've got my wife standing behind me saying, Alex, just withdraw. And I'm
Why
going,
don't you
no.
stop? Right.
I'm going, no, I'm gonna get to 100, and I slowly watched it going down and down, and I remember it hitting something like $20, and I'm like, what are you doing? And I was like, no, we're gonna get it back up again. I lost all of it, and I was so angry at myself. Like, how did I emotionally get wrapped up into this when I knew I could at any point I could have just walked away? So I think there is something inside of us that just
Absolutely.
drives us towards it.
Absolutely. But again, when you think about it intellectually, what is the advantage of the casino? Let's take your example, Alex, of betting red or black. The problem is if the wheel hits a zero or double zero,
Yeah, that
both
hurts.
both the gamblers on in red and black lose, and the casino wins. And that's what I mean by the fact that the odds are absolutely against you. And if you keep doing this, you're almost guaranteed to lose.
Yeah, it's funny because mathematically you know that you're being screwed,
Right.
but somehow they still draw a crowd. I
Absolutely.
mean, Las Vegas is
Absolutely.
still there.
And this is
It's
human nature. And, you're absolutely right. This is something maybe in our DNA that makes this very attractive.
well, I was told by my mentor. He said to me, "Don't try and get rich quick. Just get rich for sure." So he said, "Just stick with the safe stuff." He's like, "You'll see something shiny over there, and you'll wanna see what it is, and you'll wanna take a swing." He said, "Just ignore it, and you just stick with what's working, and don't walk away with it." And it's kind of why I've always had a strange relationship with the stock market because. Two of my friends, they're stockbrokers, and they both work in one works in one of the best firms in Singapore, one works in one of the best firms in Tokyo, and they do their thing, and they're great at what they do. And I said to them one time, they came back for Christmas, and we all flew to the UK, and we was having a conversation, and I don't know how it came about, but I asked my friend, I said to him, so how much money do you put in stocks? And he goes, oh no, I don't put anything on stocks. I'm like, yeah, but you're a stockbroker. He's like, yeah, that's why I don't put any money on stocks. I don't trust it. And I'm like, but you're a broker. Like, how can you not have money in stocks? Which I thought was a really peculiar thing to say. But it kind of comes down to he basically felt what you're saying. He said as much. He said the more I think I know, the less I feel that I actually know.
Oh, I think that's a wonderful lesson. Yes.
So, what is it that you think that creates successful people in Wall Street, and what is it? What separates the winners from the losers?
Well, I think the winners are clearly the people who are the slow and steady people, as I've suggested to you. The people who are sensible, they put uh, some amounts of money to work, whether it's in the stocks, in real estate, and do it consistently over time. These are generally the people who will be and who are successful. So as long as you believe that the world economy is going to grow, and I think that's the sure way to get rich. And that is basically to get rich slowly. Now,
Mm.
is it possible that that won't work in the future? You can think of some crazy terrorists getting a hold of nuclear weapons and blowing up the world. Is that a possibility? Absolutely. But my answer to that would be if in fact that happens, worrying about my investments is the last thing I'm going to worry about.
Yeah, that's true. I'm thinking if you okay, what's your thoughts about artificial intelligence? Because that's something that comes around a lot at the moment. Because I had a weird conversation recently with a fairly wealthy person, and he said to me, he said everything's going to change. Artificial intelligence is just gonna play a massive role on everything, and I don't think the humans are going to keep up. And I said, look, let's not all get doom and gloomy. All right, let's try and keep the smile. But I'm curious, what do you think that is going to have an impact on the financial markets at all?
Oh, I think it already has. I've actually, let me go back to one of the things that you had mentioned earlier. I have seen a lot of work where people have looked at social media and have tried to predict what groups of stocks are going to be popular by following the Facebook posts, by following the tweets, and whether that would work. And let me say that the reason I don't think it's going to change everything is that, first of all, again, there's so much randomness that usually overwhelms whatever regularities there might be. But let's assume that with artificial intelligence, we find a regularity in the market that we are able to exploit. I mean, let's assume that, in fact, there's something there. The problem with our markets, and this is really what gets back to the idea that markets are reasonably efficient, if there is something there, the very fact that people are buying to exploit it will mean that it will disappear. In other words, if, let's say, there's an opportunity to make an extraordinary gain, people are going to buy into it until the opportunity doesn't exist anymore. So I think that AI could very well play a role. There could be some opportunities, but that taking advantage of them will make them disappear. Let me give you an example of something in financial markets that worked extremely well. As you know, there are a number of so-called derivative markets. In other words, there are securities, there are instruments who take their value from what's going on in the underlying market. And one of these is the so-called futures market. You could buy an index fund with all the Standard & Poor's 500 stocks in it, or you could buy the future. That is to say, I could buy a contract that will give me what the Standard & Poor's 500 will be worth 1 month from now. Now, at one point, the futures contracts seemed to be different from what the underlying Standard & Poor's 500 was. In other words, if I can buy a derivative contract that says the Standard & Poor's is worth 2,390, and the underlying stocks are at 2,400, there's an arbitrage that I can do of buying the future and selling the stocks in the so-called cash market. And there was that arbitrage possibility for a while, but people taking advantage of it finally made it disappear.
Right. So it's kind of like the more, yeah, it's exactly what you just said. Like the more people try to exploit it, obviously they end up erasing it. So it's very difficult. Yes, but the thing is with AI, if someone, okay, so let's say that Goldman Sachs, they came out with the best AI in the world. That, they're trading unbelievably well. They're crushing it. Would that allow them to manipulate the market in a way that other people, like just the typical trader, like the stay-at-home dad that's trading from home, would it just be manipulated in such a way where they just couldn't possibly compete?
Well, I think that that's right. And that, in fact, if through AI they found something that clearly worked, Goldman would exploit it until it didn't work anymore. So it's not that if you find something that no one else knows that you can't profit, but eventually it will disappear.
So, okay, so then there would only be two options: either exploit it as much as you like, maximize it in the period that it does work, or what if you lowered the amount? So instead of running it at 100%, you kept it at 10% to try and keep it a little bit. Would that work, or would that still erase it?
But why would you do that? If, let's say, you're the research scientist at a pharmaceutical company, and the stock is selling at 20, and you know that you have got the cancer drug that will beat all other cancer drugs, and that when this is known, the stock will be worth 40. Why do you want to keep it at 20, 22, 25, 30? You want to keep buying it until it's 40. Why not exploit it completely?
Point. Yeah, I can't really imagine the guys at Goldman saying, "Do you know what? Let's not take all the profit. Let's leave some of it on the table for the others to take." Yeah, you've got a good point. I don't think that would happen. I think that they would just take everything that they possibly could. Now, obviously, I know that you said, obviously, you mentioned earlier that you've got a company called Wealthfront. Do you want to talk about that a little bit?
Well, what we do is two things. First of all, one of the lessons in reducing risk is to be diversified. What you want is you don't want a portfolio that's entirely in common stocks. You would probably want some real estate as well. And maybe you would like also some fixed income investments, some bonds that were issued by the United States Treasury that were very, very safe. And what we know is that diversified portfolios are far more stable than portfolios that have only one asset class, such as bonds, such as real estate, such as common stocks, such as commodities, such as foreign exchange. So you want a diversified portfolio to reduce risk. Now, there are investment advisors who generally will charge you 1% of your money or 2% or 3%, sometimes even 4% of your money to put diversified portfolios together. What we do at Wealthfront is you have to access us online, and we will do this, and we will charge you 0.25%, and we will rebalance your portfolios over time so that if one asset class is doing particularly well, we'll take a little money off the table and put it in one of the other asset classes that's not doing as well. And this is another technique that we know tends to reduce risk and can increase return. And we do this all at a very low fee because we do it all with software. And that is something that one can do with the computer technology that we have now. And we do, I think, a very good job for our investors. And, Alex, there's, another one of the handy lessons in life. I think all of us who purport to be experts in financial markets need to be very modest about what we know and what we don't know. But the one thing that I am absolutely sure of is that the lower the fee I pay to the purveyor of the investment service, the purveyor of the investment fund, the less I pay to the purveyor, the more there will be for me. And one of the sure ways of getting an above average investment performance is to pay below average fees.
Yeah, your fees are very low. They're 0.25%, right?
Exactly.
It's very low. And then, if I'm not mistaken, the minimum investment is $500. Is that right?
That is correct. Just about as low as you can imagine.
Yeah, I mean, for it, even for an average person, it's not a lot of money. Um, to start an investment, it's not a lot of money
Exactly.
to come in with. Some firms, I know some firms charge, the minimum account that you can open is like 500,000 plus. So obviously the fact that you can come in of $500 is very minuscule. And then again, obviously, like you were saying, the type of fund that it is, where you're doing index, obviously it creates a better portfolio. It's more diversified. So what would you say that the biggest benefit would be to joining like your company, Wealthfront, compared to just trying to trade on your own?
Well, I am convinced that, first of all, we use index funds. And as I've said before, indexing is a way of getting above average performance, minimizing transactions costs, and also minimizing taxes. One of the problems if you're a trader is that suppose you buy a stock at 20 and it goes to 25 and you sell it. Well, that $5 is taxable. And in today's world, you will get chewed up by brokerage fees, transactions costs, and taxes. So the other advantage of the index fund is it simply buys and holds. So it's very tax efficient. So I am convinced that this is the best way to invest. And what we do at Wealthfront is to give you the diversification that reduces risk. And let me tell you one other thing that we do, and we do it with software. We do what's called tax loss harvesting. And what is meant by that is, suppose in your diversified portfolio, one of the asset classes went down. I mean, for example, in 2018, emerging markets were very poor. They lost money. Well, what we can do is we can sell one emerging market index fund to take a capital loss and reinvest in another emerging market index fund. And this creates the capital loss, and we therefore, excuse me, instead of paying capital gains taxes, we're able to deduct the capital losses from any other gains we might have or from our income to certain amounts. So it's, I think, a very tax-efficient way of investing.
Yeah, tax is tax gets worse the more the more money you make. So if you can be tax efficient, that certainly is a benefit. So before we round down, where can people find you? Have you got a website that you want people to go to? Have you got social media?
Just go to wealthfront.com. That's all you need to do.
And how can they find? Are you on social media at all?
They are sometimes on social media, but as I say, just go to wealthfront.com and you'll be fine.
Awesome. And then if anyone's curious, they want to check out your book. Obviously, your new revision comes out in January, and the book's A Random Walk Down Wall Street. I definitely recommend picking it up.
Thank you very much, and it's available from Amazon.com at a discount.
Yeah, oh, that's awesome. Yeah, I mean, you guys are going to love it. There's going to be a link in the description as well, so that you can pre-order the book. And yeah, again, it's an absolute classic. It really is worth a read. And like I said, Burton's had tremendous success. He's done very well.
I think it will be the best $20 you ever spent.
Yeah, it's not a large investment for a book.
Nope.
It is on the cheaper side. So yeah, you guys can obviously put it on your Kindle or put it on your iPad or whatever, and obviously read it while you're wandering around. Or if you want, you can get it on Audible, because obviously they've got a deal with Amazon, so you can do that as well. So
absolutely,
yeah. Obviously, guys, make sure that you check out the book. Obviously, make sure to check out the website as well. If you haven't already, make sure to check out facebook.com/entrepreneur news, where all the latest entrepreneur news is. Obviously, make sure to press subscribe, leave any comments below. Obviously, I'm sure that Burton's going to have a field of comments that are going to come flying through. I'm sure there's loads of financial questions that are going to be thrown through from the people that are from the financial industry, whereas I am not. So I'm not keen to have thrown those questions at you. But yeah, if you guys have got any questions, obviously feel free to send email. Are they free to send you emails, or do you prefer people just leave comments and you just go through?
Yeah, why don't they just leave comments?
Okay, awesome. Yeah, just leave comments below, and then obviously if Burton has the time, he'll go through each and every single one of those. So again, guys, make sure to subscribe, make sure to leave a comment, and we look forward to speaking to you guys again soon.